Here is a question that keeps central bankers awake at night. What happens if the world stops wanting dollars? Not tomorrow, not in a crash, but slowly, gradually. Reserve managers start diversifying. Foreign buyers step back from treasury auctions. The dollar's share of global reserves keeps falling. The math on this is terrifying. A new study from the National Bureau of Economic Research ran the numbers. If the dollar loses its reserve currency status, American households lose roughly 1 year of GDP. That is over $30 trillion in wealth. Destroyed. Not because of a recession, not because of a war, because the world simply stops needing dollars the way it used to. Here is the real math breakdown. Chapter 1. What is reserve currency status? Let me start with what reserve currency status actually means. It is not a trophy. It is not about pride. It is about demand. The dollar is the world's reserve currency because countries hold it in their central banks. They use it for trade. They use it for loans. They use it as a safe place to park their wealth. Currently, about 58% of global foreign exchange reserves are held in dollars. That is down from 65% 10 years ago. The drop is slow, but it is real. Why does this matter? Because this demand creates what economists call the exorbitant privilege. The US can borrow money at lower interest rates than other countries. Foreigners want our debt. They pay a premium to hold it. That premium is called a convenience yield, and it saves the US government roughly 0.5% of GDP every year in lower borrowing costs. In plain English, the world pays us to borrow our own money. That is a good deal. That deal is slowly eroding. The share of the US Treasury market owned by foreigners has fallen from 33% to about 25% over the last decade. Japan has been increasing its holdings. China has been lowering theirs. The composition of buyers is changing, and that changes everything. A 2026 NBER working paper by Jiang, Krishnamurthy, Lustig, and Richmond studied exactly what happens if this erosion accelerates. They built a model. They ran the numbers. The results are not pretty. Chapter 2. The Goods Market Math. Let me walk you through the first piece of the math. The goods market. The dollar's reserve status creates artificial demand for dollars. Countries need dollars to buy oil, to settle trade, to hold reserves. That demand keeps the dollar stronger than it would otherwise be. If that demand disappears, the dollar weakens. A weaker dollar makes American goods cheaper for foreign buyers. That sounds good, but here is the problem. It also makes imported goods more expensive for Americans, and the net effect is painful. The NBER researchers calculated the required adjustment. With standard economic parameters, a loss of reserve status would require an 8.8% real depreciation of the dollar. That is not a small move. An 8.8% depreciation means everything you buy from overseas gets more expensive. Electronics, cars, medicine, foreign vacations. Every imported good suddenly costs almost 9% more. That is inflation, real inflation, the kind that hits your wallet directly. But here is the irony. The depreciation is supposed to help American exporters. American goods become cheaper for foreigners. They buy more. That creates jobs. That is the theory. The problem is scale. American households spend a lot on imports. They spend much less on exports. So the pain of higher import prices is larger than the gain of higher export demand. The net effect is negative. American households lose purchasing power. This is the first layer of the math. An 8.8% real depreciation. That means your dollar buys less, everywhere, and there is no way to avoid it. Chapter 3. The Asset Market Math. Here is where the math gets really scary. The asset market. Foreigners hold about $14 trillion in dollar-denominated assets. Treasuries, corporate bonds, equities. If they stop wanting dollars, they start selling those assets, or they stop buying new ones. The NBER researchers ran the numbers on this. They found that approximately 50% of GDP in dollar bonds would need to be reabsorbed by American investors. That is roughly $15 trillion worth of bonds. Who buys those bonds? American households, American pension funds, American banks. But here is the problem. American investors demand higher returns than foreign central banks. Central banks buy treasuries for safety, not for yield. They accept lower interest rates because they need a safe place to park their reserves. American investors do not have that luxury. They want returns, so they demand higher yields. The NBER study calculated the impact. The US real interest rate would rise by approximately 90 basis points. That is almost a full percentage point, and that is just the direct effect. The indirect effects are much larger. Higher real interest rates mean higher mortgage rates, higher corporate borrowing costs, higher credit card rates. Everything gets more expensive to borrow. But the biggest cost is wealth destruction. When interest rates rise, the value of existing bonds falls. Everyone holding bonds loses money. The NBER researchers calculated that the aggregate wealth loss would be roughly equal to 1 year of US GDP. That is over $30 trillion. That is the second layer of the math. Chapter 4. The Hedging Cascade. Here is the mechanism that could make this happen faster than anyone expects. Hedging. Global investors hold about $14 trillion in unhedged dollar assets. That means they own dollar assets but have not protected themselves against currency risk. Pension funds, sovereign wealth funds, insurance companies. If these investors start to worry about the dollar, they hedge. They sell dollars forward. That puts downward pressure on the currency. That makes holding dollar assets less attractive. That causes more hedging. It is a feedback loop. This is the danger that a 2026 SEPA analysis flagged. Widespread hedging does not require a speculative attack. It does not require a macroeconomic collapse. It only requires a shift in expectations. Once incentives to hedge emerge, they tend to multiply. Mass hedging makes the dollar more expensive to hold. That lowers the hedged yield foreigners earn on treasuries. That makes treasuries less attractive. That creates actual selling pressure in the cash market, not just forward activity, real sales. And the alternatives are too small. The euro, yen, and Chinese bond markets cannot absorb rapid large flows, so the selling concentrates in treasuries. Yields spike, prices crash. Banks that hold large quantities of treasuries suffer mark-to-market losses. Their capital erodes. They pull back from lending. The entire financial system freezes. This is the third layer of the math. A mechanical response. A cascade. No speculative attack required. Chapter 5. What happens to your money? So what does this mean for you? Let me put it all together. The goods market adjustment costs you 8.8% purchasing power on everything you buy from overseas. That is, your groceries, your gas, your car, your phone. The asset market adjustment costs you 90 basis points on every loan you take. Your mortgage gets more expensive. Your credit card gets more expensive. Your car loan gets more expensive. The wealth effect costs you roughly $30 trillion in aggregate. That is your retirement account, your home equity, your savings. All of it loses value as interest rates rise. And the timing is uncertain. The dollar's share of global reserves has been falling, from 65% 10 years ago to 58% today. The trend is clear, but the pace is unpredictable. The UBS 2026 Sovereign Investor Survey found that reserve managers are losing confidence in the dollar's foundations. Fiscal dynamics, political dysfunction, the strategic use of sanctions, these are no longer fringe concerns. They are mainstream. But allocations have not caught up to beliefs. The gap is growing. The key message from UBS is important. Change is more likely to come through crisis than gradual adjustment. Reserve managers are conservative. They do not make grand strategic bets. But if a crisis forces them to move faster, there is no substitute for the dollar ready to absorb the flow. Here is the bottom line. The dollar will not lose reserve status tomorrow. But the erosion is real, the math is clear, and the cost to American households is massive. The dollar's privilege is real, but it is not permanent. The math says so. If this video taught you something new, don't forget to hit like and subscribe. Thanks for watching, bye-bye, and I'll see you in the next video.